And here we are.
In investing, we're all hunting for that next big thing, right? That one stock that's just going to take off. But what happens when you actually find it? Well, then you face a much, much harder question, one that honestly trips up even the pros. When do you sell? So today, we're going to get into the critical skill of knowing exactly when it's time to step off the ride.
I mean, this quote just hits the nail on the head, doesn't it? Buying is easy, it's the exciting part, it's full of hope and promise, but selling? That's where the cold, hard discipline has to kick in. It really is a rare skill, and it's what separates the pros from the amateurs, and it's exactly what we're going to unpack today.
So what even is profit taking? Well, think of it like a constant balancing act. On one shoulder, you've got the fear that the market's about to turn and wipe out all your gains. But on the other shoulder, you've got that little voice of greed whispering, come on, just a little bit more. The goal here is to silence both of those voices with a system that turns those paper profits into actual cash in your bank account.
This is the million-dollar question, right? But here's the secret. It's not about trying to perfectly time the top of the market, because let's be real, nobody can do that consistently. It's all about having a plan in place before your emotions grab the steering wheel. It's about switching from hopeful guessing to a repeatable, systematic approach.
And the good news? You don't have to invent this stuff from scratch. Almost every profit-taking method out there can be boiled down to one of three core strategies. Let's think of these as the essential tools in your investing toolbox, where each one is perfect for a different kind of job.
So here they are, our three main approaches. First, we've got something called scaling out. Second is using technical exits. And third, there's a strategy known as value realization. Each one of these has a completely different philosophy behind it, so let's break down what they are and who they're best for.
Okay, this table lays it all out. First up, scaling out. This is a favorite for momentum traders. You basically sell your stock in pieces. So maybe you sell a quarter of your position after a 20% gain. The cool thing is you lock in some profit, which feels awesome, but you still have skin in the game if the stock keeps running. Then you have technical exits. This is for the chart watchers among us. Selling when a stock breaks a key trend line or crosses a moving average. And finally, value realization. This is the classic fundamental investor's move. You do the hard work, you figure out what a company is really worth, and you sell when the market price finally catches up to your valuation.
So you've got these three core ideas, but how do you actually combine them into a system that works in the real world? Theory is one thing, but let's get practical. We're going to walk through a real, pretty conservative framework from the SDIF platform that's all about keeping things simple and protecting your gains.
The whole idea behind this is actually really simple. Let your winners run as long as you can, but have an alert system. This system basically raises a red flag in two very specific situations. First, for your high flyers, those stocks that have just been on an absolute tear. And second, for the laggards, stocks that look cheap on paper, but their price is just going nowhere. It's a classic value trap.
And here is where the discipline really starts. This system isn't about staring at your portfolio every single day. No, the process kicks off with a simple, scheduled review just once every 3 months. That rhythm is designed to help you tune out all the daily market noise and stop you from making those emotional, knee-jerk decisions.
Now, during that quarterly review, the key number you're looking at is something called the return to market ratio, or RTM. Just think of it like this. If the S&P 500 went up 10% and your stock shot up 13%, your RTM would be 130. It's just a simple way to see how much your stock is crushing the average. The SATA framework sets a really clear trigger. Any stock with an RTM over 130 gets put under the microscope.
So you've got two distinct groups that the system flags. First, those high flyers we just talked about, with an RTM over 130, but it also flags the stagnators, stocks with an RTM between 95 and 100. These are the ones just treading water, barely beating the market, and you have to ask the critical question, are they losing steam? Are they about to sink? Okay, now here's where it gets really clever. Once a stock gets flagged, the next step is to check if its momentum is fading. For those high flyers, you're looking for a 15-point drop from their peak performance. But for the stagnators, the leash is tighter. You're looking for just a 10-point drop. This is a huge signal that the best days might be in the rearview mirror, and it's probably time to think seriously about locking in those profits.
Look, the SATIF approach is a fantastic template. It really is. But the ultimate goal here isn't for you to just copy someone else's system blindly. It's to use these principles as a foundation to build a set of rules that works for you.
And that plan absolutely has to be personal. It needs to match your unique investor DNA. You've got to ask yourself, how much of a drop can I really handle before I panic?
Am I investing for next year or for the next 20 years? What am I even trying to achieve with my money? Your rules have to be a direct reflection of your answers to those questions. And you can get creative and blend these strategies. For example, you could use a scaling out system like a 50-30-20 rule. You sell half when you hit a certain gain, another 30% at a higher target, and you just let that last 20% ride. Or you could use a trailing profit stop. That's a technical exit that automatically moves up as the stock climbs, locking in gains. Or maybe a hybrid. Sell when you hit your valuation target, then step back and reevaluate. The point is, you can customize this to fit your own style.
And all of this brings us to what is, without a doubt, the single most important point of this entire conversation. It doesn't really matter if your system is perfect. What matters is that you have a system. Any plan, even a super simple one, is infinitely better than just winging it, riding the emotional roller coaster of hope and fear. Making random panicked exits is the fastest way to turn a winning trade into a portfolio disaster.
So, at the end of the day, always remember this. Until you click that sell button, your profits aren't real. They're just numbers on a screen, totally vulnerable to the market's next mood swing. A real profit-taking plan is the machine that turns those paper gains into actual wealth. It's how you make sure that when you win, you actually get to keep the winnings.
Okay, so we have here some ideas about when you should take a profit, but we need to delve a little bit more on this issue, which is really a very important issue. And we have here well, let's start with a different approach, which says that ideal. Some investors, like long-term investors, they usually say, when is the time to sell? And they say, well, never. So if your horizon is 10 years, you should only sell at the end of 10 years. If it's 5 years, you should only sell at the end of 5 years, and so on. But of course, this is an extreme view because it's quite rare that even your best performance stocks remain best performing stocks all the time. But remember again, the purpose of portfolio management is to keep the winners and drop the losers. So if you have here the winners and we want to drop the losers, okay, the thing is that we want to keep the winners here. But if we have the winners here and we have some of these that are neither winners nor losers on the mid ground. So the thing is, how are you going to make sure that a good winner, when let's say our top stock here, which starts declining, is not going to become to join this group or even fall into this group, which sometimes happen. In the losers group, how are we going to prevent that? So there are a number of strategies like these 3 that we have identified here. The first one, which is that we start selling portions of that position periodically, and which is so-called scaling out, getting scaled out. But what happens is, if I sell this, let's say this is my best stock, which is currently like this, but it continues moving, and I keep reducing my position, so I have less and less stock. So the impact of this stock into the overall performance of my portfolio is going to diminish if I do this kind of averaging out my return. But it's a very conservative way of managing a winning position, which is selling it in tranches and trying to do that. But again, this is a very has this inconvenience that we may start selling when the stock is already recovering, and then we have this regret to deal with. How we should do that. The other thing is to set some technical limits. So let's say that if I have a limit here, So if I say that, I have set a limit here, I sell whenever the stock reaches that limit. That's something that people very often do. So where they have a limit on how much the price can appreciate, and they follow that. And the other thing is to look at the valuation. So the other way to do this is the technical analysis, and the other one is to look at valuation. Say if the valuation is falling, and especially the intrinsic value is falling, then that can be also a reason to start selling our winners and our best stocks. So we can use all these methods. We have all the tools. If you remember correctly, you have this chart showing the evolution of the intrinsic and valuation, relative price valuations compared to the actual price. So we can look at that. We have other measures of valuation. We can see which ones are. We have also technical analysis. We have our price target. And we have a new tool, which have already mentioned here. That's the so-called new alpha. You have the new alpha tool that actually, gives us a sign, you're saying whether the stock is a hold, a sell, or a wait. And this is again a new tool that we have and that we can use also to give us some guidance. But of course, before we decide that, we need to go to our platform and look into how the stock is performing and see what we should look at. Okay. I think I'm not sure if we have it on this slide here. I think we may have here, or we go to the platform. Shoot. Okay. Now let's not move into this yet, and let's move to the platform. I'm not sure if it's here. No, portfolio manager. Okay. Can we use this? Okay. Now let's use this one. Okay. Let's choose here. Okay. Let me see if I have these all types of situations here. Okay. The first thing I have here a portfolio. It's actually an actual platform of stocks invested in the US. And the first thing we should go is to look into our periodically into our manager section, look into our portfolio. So we can have in the platform multiple portfolios. As you see, I can have a few portfolios. I can group them together. So this is especially useful if you are an advisor and you want to use the SADIF platform for your advisor activity. You can have your positions organized by client or by strategy or by currency, whatever way you want to do that. So I'm going to use this US positions. And so the first thing you need to do is actually to check your worst positions. Okay. Let's say check your worst position. So you have here one, and fun enough, you have a few of them that are losing. It's not always the one that is losing more, like we have here. The one that is losing more actually has a yellow light here, a yellow. If you remember, we have 3 colors to identify positions that need to be looked at. What does that mean? It means that we need to carry out a new diligence to see whether we should keep those positions or we should close those positions. So here I'll show you the trouble marking positions. Some of them don't have any alert yet. Let's say, for instance, this position here, which is actually Apple. I was talking about this one, but Apple is still. Wait a second. This is not organized correctly. Should be here. No. Okay. I think now we have them ordered by losses. So I have here these two positions, the Netflix ones that I was telling you about. And so these are positions that are running at a loss, so they are losing money, all these positions. Not so much this here, but I have one position here, for instance, that is just losing 4%. So 4% is not really something that should worry us, but 24% is something that can worry us or not. But sorry, I was looking at losses. I should be looking at profits. So let me look at the profitable positions and see if I have here a problem or not. Well, so far no problems here, but if I move down my list, I have this position here, which is now earning just 38% here. But I have an alert here, and this alert tells me that the position has been following significant from the peak. So you see, I look at the peak, she was 50% the market at the peak, and is now only 23% above the market. So this is my first alert, which is a green alert that tells me I should pay attention to this stock. In this case, this Broadcom. And I should look at this stock and pay attention on this. But this doesn't mean that I'm going straight away to close the position. So she's probably somewhere higher. It's below the top. It's lower, but doesn't mean that I should go and realize whatever profit I have here and just move on to some other stock. But I'm sure that I have here some of them, like this one here. Actually, funny enough, I don't have any on this portfolio. I don't have any losing money. That is, I wanted to show you an example, but I don't have any in this portfolio. I have a few yellow positions here, but they are not. They were not on the top of my portfolio. Maybe if I choose a different portfolio here, let's see this one here, Neuro portfolio. If I have here a few. Oops. Okay, not this one. Okay, not the Euro ones, maybe the Japanese ones. They have been doing badly, so maybe I can have a. Okay, not the yellow one. Okay, no, not finding. I was trying to find here one. Not this perfect. Well, let's look at the whole thing and see what I can have here. Okay, losers. I have here the winners. Okay. Actually, just by the way, let me draw your attention. Once we have built a position like we have here in this stock, where the position was built in various periods of time, it may happen that one of the transactions has a green alert, and another one may have a yellow alert or even a red alert, depending on the date when we created when they did the transaction. Although in aggregate they have they can be without any reason for alarm. Okay, but what's happening? We don't have many. Well, you see, because we try to we try. I don't, yeah. I was looking for an example, but because this is real money, so I don't usually let the positions to get into that situation. But I was looking for an example. Maybe if we leave this portfolio and move into a paper portfolio like the one for the US, maybe we find some of those positions, and I'm not sure. I was trying to see if I could have. Okay, gains, okay. Unfortunately, I also don't have one of those positions I wanted to show you. Position with a yellow, maybe this one, no. We have here this one. But only shows for this position that we have, the Royal Caribbean, so we have a gain of 70%. But if you look at the alert here, it is yellow, which means that we should consider selling this position. Why do we consider selling this position? Because it has declined. So you see this stock at the peak was 41% above the market, but now it's just at 6%, which means that when we risk losing any profit that we had in this stock if we continue holding it. So this is a situation where we should consider selling it, this stock, unless based on our due diligence. So if we're going to do a due diligence on this stock, then if we consider that it's going to recover, it has very good prospects of recovery, then we can risk. But if we don't want to risk, the more conservative approach would be to earn this 6% and forget about the stock for the time being, rather than risking that the stock is going below 1, so below the market. So the stock we would still sell the stock right now with earning 17%, which is not that bad, but we don't risk getting to a position where we sell the stock at a value below the market rise, or even a value where we lose money. So it's a question of being very attentive. So you see, this is our key tool to analyze then when we should close the stock or not. But we have other tools that are equally important. And if you allow me, is looking at unrealized gains. If we go to this P&L section of the evaluation, which we'll look at, we have here a number of stocks that with unrealized gains or losses. So what we can here do is, if we want the gains, okay. So here you have, for instance, this stock here, which has a huge buffer of actually these three top stocks are have a huge valuation increase, all these of these, and some of them may have a strong impact on our on the value of our portfolio. Like this one, the return is 105,000, so it means that we leave this stock to go down substantially, so a lot of our gains will be reduced. So we have to take into account also the impact that a reduction on a fall of this stock would have in our impact, because it has a very high weight. It's a high weighted stock in our portfolio, so you have to take that into account. So again, there's another issue that we have to consider when looking at managing and deciding on profit taking, is the impact that taking profits will have in our portfolio. And we can do also something which is easier if you have several stocks that we are in doubt. In the manage section, we can actually replicate copy a portfolio. So if we want to try the impact on the whole portfolio, we may create a copy of the portfolio and then do those theoretical transactions in that duplicate portfolio. This is again another feature of this function. Okay, just to conclude, let's first remind then why deciding about profit taking is so difficult and so necessary. And the reason why it is so difficult, it is because we we can have a clear cut when defining when trying to stop a loss, but when deciding to take profits, you know, the greed and the regret feeling always prevent us from taking this conservative position, which is closing the position before it reduces its value more. So, and that is really, and you will always let, you know, whatever we do, always end up feeling that we did the right thing. So an exercise that I would recommend for people to be able to deal with this type of situations is actually when you have your paper portfolios, you can actually practice taking profit-taking decisions under different scenarios, and then after some time you can actually go back and check, you know, I was wrong, I was right, why I was wrong on this decision, why I was right on this decision, and that way you certainly learn a few things about what would be the right decision, first with a certain change in the price and the reduction in your profit. But in the end of the day, we always made some mistakes. So it's a question of, you know, have your experience harden up a bit without being with real money, but having it also harden it in a simulation environment, which of course is less costly than if you are doing it on a real environment. Okay, so this is the essence of stock profit taking. In the next tomorrow we'll deal with the stop losses, which also has, as I said, it's much easier but has its own complications, and we'll deal with them tomorrow. Okay, thank you very much for today's session and to be with us, and we'll see you again tomorrow. Okay, thank you. End meeting.